Going through a divorce brings many emotional and financial challenges, and taxes are no exception. Your filing status, deductions, and responsibilities may change significantly, depending on the details of your divorce. Here's a guide to help you navigate tax filing after a divorce. Your marital status as of December 31st of the tax year determines your filing status for that year. You typically have three options. Single. If the divorce was finalized by December 31st, you file as single. Head of household. You may qualify if you paid more than half the household expenses and your child lived with you for more than half the year. Married, filing separately. If still legally married on December 31st, this may apply, though it often results in a higher tax bill. Head of household generally provides better tax rates and a higher standard deduction than filing as single. Only one parent can claim a child as a dependent. The IRS typically gives this right to the custodial parent, the one the child lived with most. However, parents can agree in writing to let the non-custodial parent claim the child using Form 8332. You may be eligible for child tax credit, earned income tax credit, and child independent care credit. These credits have specific rules, so work with a tax professional if you're unsure who qualifies. Alimony for divorces finalized before 2019 is tax-deductible for the payer and taxable income for the recipient. Alimony for divorces finalized in 2019 or later is no longer deductible or taxable. Child support is not deductible for the payer and not taxable to the recipient. Dividing property in a divorce typically does not trigger immediate taxes. However, you should keep records of who received what, since selling or withdrawing certain assets later, like retirement accounts or homes, can lead to capital gains taxes. Be cautious with retirement accounts. Early withdrawals could result in a 10% penalty if not handled correctly. Using a qualified domestic relations order, or QDRO, for splitting 401(k)s or pensions can help avoid penalties. After divorce, don't forget to update your W-4 with your employer to reflect your new withholding needs. Change your name or address with the IRS and Social Security Administration, if applicable. Consider estimated tax payments if your filing status or income has changed significantly. Divorce changes more than your relationship status. It can affect your taxes for years to come. Working with a tax professional like SK Tax Associates ensures you understand your obligations and take advantage of any benefits available. Need help navigating taxes after divorce? Contact SK Tax Associates for personalized, confidential tax support.